Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective, the Perspective social media platforms. Yes, you get all my mistakes. And I'm back to talk about our stock market investment strategy using closed-end funds. And it's a very interesting market. So the normal disclaimers. This is an unedited video. As you can see, you get to watch my mistakes in real time. Who knows what you'll hear in the background as I film these in my house. My cat is currently fed and hopefully satiated. So hopefully he won't be running around like a madman. I'm not a financial advisor. I am a financial strategist. I don't speak like the herd. I walk in very limited company, and sometimes I walk alone. Um, I said this last week. If and I'll still pose it as a question: will you help me hack YouTube and just help more people outperform the herd? Comment on the videos. The more comments, the better. Share the video. If you want to help people generate return on better return on investment, better dividends, uh, the algorithm reads that and then uh, puts the video in front of more people and then likes. Positive feedback is good. If you have negative feedback, by all means, drop a comment and let me respond to it. And if you really do want to help me hack YouTube, then like the video, share the video, and leave a comment. All right, so I'll stop hounding you for support. Um, and if you had to follow the video or following the channel, that would help as well. And thank you in advance for all of that. So, are there notes and important information from the past week? Gosh, yeah. Um, if we backtrack a week further, so I mean, the last week was volatile, right? But the end of the week before that, we have that massive sell-off. So this past week was pretty telling, and it confirmed everything I've been saying. We should take Treasury Secretary Scott Bessent's advice and pay attention to the 10-year yield. Right, that's dropped a ton since he's been in office, and that's important because it speaks to what he and Trump are trying to do. I say he and Trump, but it's really President Trump and him. So 2 weeks ago, we'll say we have the Tariff Day and Liberation Day, and then last Thursday, Friday, I guess a week ago, Thursday, Friday, we have that massive. Even before that, let me see. We bought the dip. So let me see when our specific buy date was. We bought April 7. Crazily, that was the beginning of the week. Um, Monday was supposed to be a weird day, but we bought the dip anyway. Um, yeah, say la vie. Uh, but so after all the tariff talk and the market dip we saw last week, I believe now more than ever, the corporate media knows next to nothing about anything, and that President Trump and Bessent are forcing the Fed to lower rates. And all the people who were supposed to be experts, like there were experts on those crazy ass college degrees and student loans, and then those people turned into experts on how it's bad to cut the government waste and into experts on tariffs and the economy and everything else in between. At least half of the herd's bell ringers are nothing more than trained puppets reading a teleprompter. The other bunch know what they're doing and couldn't care less about the herd or me or you. And yes, I do believe President Trump and Bessent are using the herd and their teleprompter bell ringers to force the Fed to drop rates because if you can control the herd and you can control that deeper current of the economy, you control the game. And in simplest terms, everybody's freaked out about tariffs because the herd itself just doesn't understand tariffs. If you watch the news, it's tariffs are bad with no explanation of what they are. Tariffs are just the cost to do business in somebody else's country. If if it's me, you, and a friend, and I'm charging you 2.5%, and I'm charging your friend 25%, that's not a fair environment, right? If you're charging me 2.5% to import cars in your country, and I'm charging you 25% to import cars in my country, that's not a fair trade. That's not a winning situation for you. So President Trump is increasing tariffs and it currently putting a pause on tariffs to a degree, or putting a pause on reciprocal tariffs and leveling everybody who's come to the table to 10%. So he's implementing tariffs to bring people to the table to better negotiate trade and get a better deal for America and henceforth you and me. And I like that. It's nice to have the government work for us as opposed to the government work for the government getting bigger and enriching the government. Government in a republic, the government is by and for the people. In the bureaucracy, the government is by and for the government, which continually gets bigger. Doesn't help you or me. So tariffs just bring people to the table. They get your attention and they bring people to the table so we can negotiate a better deal. Now, President Trump announced Tariff Day is Liberation Day. Why? Kind of a weird thing if you don't think about it. Liberation is from taxes. The government has funded our, well, the government has funded the budget off the backs of the American taxpayer for the last 100 years. Pre-Fed, pre-IRS, the budget was funded by tariffs. With the External Revenue Service, the ERS, Trump plans to pay off the debt, and he's planning to fund the budget through tariffs instead of the IRS system. I'm talking about liberation. Can you think of a world with no taxes? You've been trained to think that taxes are part of life. Can you think of a world where there are no federal taxes? Mississippi became the first state to go with no income tax. Texas runs a general 8.25% general tax on everything. Think if that went away. Doesn't sound like that big of a deal. For every $100 you spend $8.25 in surcharge for whatever you're buying. But what if that went away? Small things add up. Federally, pending your tax bracket, think of that. 22%, 30%. Think of no federal taxes. Think of no IRS, right? If you don't pay taxes, there's no IRS. Instead, we have the ERS generating income through all of tariff money. I think that's pretty cool. I mean, Trump's already floating the idea of no taxes on people who earn 150,000 or less, right? And it sounds kind of like a pipe dream because you've got to get it through Congress. But just think about it. If that passed, complete game changer across a lot of different platforms. So, as I said last week and really the week before, tariffs don't increase inflation. Studies have shown that. Tariffs protect American workers and American products. Everybody wants access to the American consumer, right? If they want access, they can pay to play. Tariffs generate income for the country and level the playing field in our favor. President Trump already announced the 90-day reprieve for everybody at the table. And currently, the U.S., by doing that, the U.S. is cutting China out and honestly cutting China off. Every country abandoned China for the U.S., right? All of those countries could have said, no, we'll deal with the tariff war game. But all of those countries reacted and said, wait, we want to negotiate a better deal because they want access to our market. They also want access to us, right? If the U.S. truly leads, the U.S. truly leads the world, right? People want to do business here. You can be a U.S. company making stuff in Taiwan to then import it back here, or you can be a U.S. company making stuff in the U.S. and just sending your stuff around the country. And that's what Trump's trying to do. He's trying to onboard manufacturing into the U.S. And every company, those 70 countries, abandoned the China system and signed on to renegotiate with the U.S. So that puts China and the U.S. in a tariff war, or what the news will tell you was a trade war. But I'm honestly with Kevin O'Leary on this. Kevin O'Leary's like, if you think of the pendulum swing, the media goes, oh my gosh, tariffs are bad. Kevin O'Leary is the flip end opposite. And Trump actually sits in the middle. Kevin O'Leary has said for years, no one's been able to corner China. And now we have somebody willing to take on China. If you look back 20 and 30 years ago in Congress, which is really why we need term limits, but that's a conversation for another day. 20, 30 years ago, you had Pelosi and Schumer advocating for the same thing. We need a better tariff system in order to prevent China from getting into the US. Now that they're owned by China, they want to keep China in the US. But you have Kevin O'Leary advocating for 400% tariffs and to squeeze the Chinese on access to the American economy and access to the American consumer. You've got DeepSeek AI and TikTok still, and that's being negotiated. Uh, you've got Timu and everything else trying to come into the US. And currently, well, I'll say pre-tariff war, it was easily getting like the tariff system sucked. All of that jumping through the loophole, not getting taxed. And now it's look, if you want to do business here, you're going to pay the taxes to do business here. Like you're going to pay the entry fee to get into the market. No slipping under the rope for you. And Kevin O'Leary is give it to the Chinese, like 400% tariff, squeeze them out and make them relent. And I'm with him. Okay, that protects the American economy, that protects the American consumer, and that also protects America's intellectual property. And you know this; it's just not phrased that way. Intellectual property. You have this great idea, but China steals it, makes it super cheap, imports it back into America, sells it to Americans, and then undercuts you so bad that you have to close shop. China's been doing that for years with everything from simple ideas like t-shirt companies and stuff you might sell on Amazon to stuff that's on your computer to really tech savvy stuff. And we finally have somebody in the government that wants to protect America and Americans and American interests. And he's going to do it, whether the media likes it or not. And honestly, every time the media screams about something, it's generally a red flag that something's going right for America. Tariffs. Tariffs encourage American companies to manufacture in the US, and it encouraged those companies to help create a local and domestic supply chain that's reliable and readily available. If you remember the lockdowns and not having enough materials and supplies, because for whatever reason we export, or I guess we exported a ton of our stuff, and then we imported the same stuff. Like we exported food all over the world, and then we imported the same food from all over the world. That makes no sense. None. So in a global lockdown, nothing comes in. And honestly, of what's pumping out and gets sold, nothing's going out. So all that stuff perishes. Uh, it, by implementing tariffs and encouraging US based manufacturing, we're encouraging an independent and free or an independent and localized supply chain. So instead of buying all that crappy stuff outside of the US, that yes, it's cheaper and it might last a somewhat amount of time. It's not well made. You and I know that. We can buy nobody buys handkerchiefs. You can buy an undershirt or pair of socks outside of the country, and buy another same pair of socks inside the country, and you can look through them. And one looks like semi-transparent membrane, and the other actually looks like a sock, right? The stuff that's not made as well is going to deteriorate faster. We don't want the same stuff in our medical supplies, right? Or our medicine, or if you take drugs, or if you need needles and syringes. You don't want that stuff made outside the US. You want it all made locally so you can have it readily available. Currently, Apple has talked about opening new plants in the US, like $500 billion worth of investment. Nvidia, similar. Ford just announced they're gonna open 4 new plants inside the US and bring along 25,000 high-paying jobs. Right? Tariffs are great for the country, but the swamp doesn't like it. The swamp and the media don't like people doing better than themselves. So the swamp's propaganda team, the corporate media, and the teleprompter jockeys, they've been pumping fear into the herd about the risk and the dangers of tariffs. Why did the market dip? Because the herd got corralled and schooled. And the media think they're the ones controlling the markets, but they're not. They're reactionary. When everybody says the same things, someone else is pulling the strings. And I believe Trump and Besant are manipulating the herd's puppet masters. The news itself is not telling you about the good news going on generally, right? If they are, it's this really small 5 to 10 minute segment in a 50, in an hour newscast where the other part is 50 minutes of doom and gloom, right? It's little glimmers of hope and not just here's the news locally. You can look at every single news station inside the corporate husk, and all of them are using the same lingo. And not like it's changed into that lingo by 5 p.m. Right off the bat, 6 a.m., 5 a.m., 5, whatever the first episode or station comes on, it's the same exact thing all day. And the herd hears that every single day. So you can go to ABC and CNN and Fox News, right, or NBC and C-SPAN and PBS. They all say the same stuff. And the herd watches and the herd gets info and the herd freaks out. And I believe what President Trump and Besant are trying to do is they're really attempting to manipulate the Fed. Why would you? Like, why manipulate the Fed? Right? Well, the Fed, you can't, there are a lot of different departments you can force to do things, but you can't force the Fed to do anything. The Fed, manipulating the Fed from where we are, stagflates, right? Or stagflation. We have lowering inflation and our rates have stayed the same. So if the Fed lowered rates, lower rates help everybody from the top down, but the Fed's not lowering rates. So how do you force the Fed to react? You do tariffs. But but what does that mean? It's really a fight for the herd. If you can control the herd and their perception, then you control the market and thereby the economy. And if you're really at the top of the chain, you can force the reactionaries to react. So think about this way. So President Trump announces tariffs. He talks about it beforehand, so it's no surprise. But then you have Liberation Day, and here are the tariffs, right? I mean, he's been talking about tariffs for at least 15 years. The last time he tried to nail China to the wall with tariffs, COVID happened. This time's different. So Trump enacts tariffs and wages a direct financial battle with China. But he also wages an indirect battle with China. So you have the propaganda news team and their puppet masters. Trump does this, they react. Trump does that, they react. Everybody says the same thing. It's a coordinated reaction. So President Trump enacts tariffs along with Scott Bessent, who's pushing for a better 10-year rate, right? You can't change the short-term rate because the Fed controls that, but we can focus on the long-term rate. So if we can do that, if we can focus on the long-term rate, cheaper oil, decent job market, lower rate, right? So that's what we're going for. So tariffs happen. The reactionary news reacts. They pump fear and doom into the herd. The herd hears the fear and gloom and freaks out because they see the short game and they hate risk. The herd is mostly newbie investors. But honestly, I think our last financial guy was part of the herd based on how he was investing our portfolio. And that's why he's not investing our portfolio anymore. So the herd is mostly newbie investors, but there's a lot of seasoned, supposedly expert investors in there too, right? There's a lot of just not great advice inside that mix. So the herd hears the fear and the gloom and they freak out because they see the short game and they see the risk, right? The herd is the group where the market does well and they push money into the market late. And then it swings into fear and they pull money out first, right? They hate risk. They want the quick reward. They're not looking at a long game, big picture thing. They shift money around like crazy and they really swing the market. So the herd hears fear and gloom and they pull money from the market. And the sell off creates more fear inside that propaganda echo chamber. You have a massive sell off. And that was the time to buy. I know the market's going to be volatile. I know it's going to go up and down. I know that the tariff war isn't ending tomorrow, right? We're talking tariffs for at least another 90 days and then however long it takes China to cave. If you're listening to President Trump, China wants to make a deal. And to be honest, China probably does want to make a deal. But if they cave to the US, they admit they're second, right? So you have your you've got two heavyweights contending for number one. China with Xi is a juggernaut. The US with Trump is a juggernaut, right? We were pacifist and we just yielded to everything. That's not the US anymore. And instead of reacting to the fight or sneakily causing a fight, we're taking a direct approach with China and saying this is what's going to happen. And we're predictating the terms of the negotiations, right? This is what we're going to do. You're going to relent. And like any classic juggernaut, like it'd be like if Mike Tyson and pick your other heavyweight went to weigh in and Tyson pushed the other guy, right? Those guys don't tend to cower and walk away. They tend to push back. And that's what we've got just in financial terms. So that you have the US going, this is how it's going to be. You have China going, no. The first one to buckle loses. It's not going to be the US, right? Kevin O'Leary wants 400% tariffs. We could go to 800% tariffs. With the rest of the world on our side, China can only exist so long, right? But the time to buy was the dip. And now we're in volatility. It's going to go up. It's going to get better. It's going to get not worse. It's just going to do this, right? So it go back to my share screen so I can see my own image. Not really my image, but my fingers. It went from here down, right? Like tariffs happened. And then we had the resurgence. Maybe it didn't gain that much ground, but now we have volatility. So for every good thing that happens, it's going to go up. And for everything that gets spun into a bad thing, it's going to go down. Plus, just have the general track of things. But I would imagine 90 days from now, it's going to trend upward. But once China caves and you have the US domination or in dominance again, true dominance, right? Where the US dictates the terms. China says, yes, we'll come to the table and talk. That'll change things. Then you have the renegotiated treaty in America's favor. That'll change things. Then you have everybody working in tandem again, China for itself, Taiwan for itself, North Korea for itself, etc. Right? But the US surely in the lead and the market will respond. But until that happens, we have volatility. Good night. This video. So the time to buy, honestly, the scary time to buy was when the market tanked. And it didn't hit rock bottom, right? But it certainly went lower than it's been in a while. That was the time to buy. Right now, I think you can still find a really good deal. You're just not going to find as great a deal as you could a week ago. And you're still going to find an amazing deal compared to where it was pre-tariff war, right? But it's still perspective, I guess, overall. So getting back. So we have the announcement of tariffs, direct confrontation with China, the news response, fear and gloom, the herd response pulls money out, market tanks, we bought. And then you have to factor in some other stuff. The Fed stopped printing money. The Fed was doing that quiet QE nonsense where they tell people one thing and then they quietly print money and they flood the market and they somewhat prop up the economy and the stock market with money, but at the same time they devalue the dollar because you're over printing money. When Scott Bessent took over at the Treasury, the Fed stopped printing money. So if you imagine the analogy I used last time, there's a blanket for it. Like, so if you take your couch, then you take some chairs and like a mop and a broom, and you kind of have this lumpy blanket for it. It's like the Fed was propping up that fort with a broom handle. And then Congress was propping up that fort with a mop handle by how much money they were spending. And they were overinflating the market. So when they stopped, meaning when the Fed stopped printing money, and when Doge came in and said, "Hey, you can't spend all this money," like we're spending money at a rate so high we might actually go bankrupt. Scott Besson said we're not going to borrow more money. I mean, that puts more debt on the back of the American taxpayer, further burdens the system, right, and takes us closer to bankruptcy. Think about that. No one wants a bankrupt, defaulted U.S. system. Nobody. So we have all these little things helping to prop up the blanket for it when it really didn't need to be propped up. So by taking money out of the system, we're actually cutting inflation. So the Fed stops printing money, right? Now there's no new money to prop up the stock market. And despite the lack of deflationary currency, the economy keeps chugging along. So everybody thought the blanket fort would collapse, or at least that was the reason they were giving. But instead, it stays intact. The economy keeps chugging along. Now you have Doge pointing out waste, fraud, and abuse and stopping payments. And you have department heads further cutting waste and spending and fraud. So now we have less government spending. Now we also have less inflation. Same thing. So we took out the broom handle and the mop, and the blanket fort stayed intact. The economy itself is chugging along. Within 2 months of President Trump being in office, inflation halves. In 3 months, we have the first back-to-back decrease in inflation since the early days of Biden's presidency, when the country was coming back online following the pandemic. And while all of that other stuff happens, the job market itself is humming along. The fear is that the job market will be flooded by all these government jobs being cut. But the job market itself is doing pretty decent, right? So now we have an employed society facing lower cost, right? So why lower cost? Well, if you cut inflation, you can buy more with less. So we have an employed society facing lower cost, prepared to thrive, right? Now you add in, so if you look at Bessent's overall plan, wishy-washy on the job market. Some say great job market, some say bad. We need more oil. We need cheaper cost. So if we're going to pump more oil, which we are, and inflation is less, we have, and I'm kind of going off topic, but I'm following my train of thought. Uh, the cost of oil impacts everything. So if we have more oil, everything gets cheaper. If we have less inflation, everything is cheaper. And when more people are employed, we have more people able to buy. And when things are cheaper, more people are interested in buying, right? When everything's are cheaper, more people are interested in buying into the market and investing in the stock market and saving for bigger stuff down the road. So an employed society facing lower cost will thrive. And adding lower rates, adding lower short-term rates to that equation completely changes the game. The bond market and the proxy markets take off, right? The market as a whole takes off because of lower rates. The economy breaks open and roars. Mortgage rates are cheaper, credit cards are cheaper, debt is easier to manage, right? Overall, everything drops. But now it's the waiting game. So we have countries renegotiating trade. We have the White House negotiating trade deals in our favor. China's getting squeezed on access, right? And they're honestly getting left out of the trade group. You have The US brokering deals with everybody but China, right? And if there's anybody else on the existing reciprocal tariff list, which I don't believe there is, it's China in that group, but it's everybody but China is getting renegotiated. And the longer China holds out, the better it gets for America. I get the fight itself is going to be played up in the media. The media is going to make it this huge thing, and it is a huge thing in the sense that we have two juggernauts vying for number one, right? And President Trump doesn't back down from a fight, and Xi hasn't had a decent fight in a long time, right? So the longer China holds out, the better it gets for us. And with inflation dropping and the American economy still chugging along, the Fed should act and cut rates, but they haven't because the Fed likes control. The longer the Fed holds out, the more they look like they're trying to manipulate the market. We know they have. It's like the we know, they know that we know that they know that we know they've done it. But the longer they hold out, the more obvious it gets for the herd. The Fed likes control. They like to be the ones in charge. They don't like to admit they're reactionary. They like the image of them being in control and at the front of things, right? They like to make the rules for gameplay. They don't like to follow the rules as they stand. They hate, honestly, they hate getting manipulated more than the media hates getting manipulated. So, but at some point, the Fed's going to have to cave. They've lost the talking point war. So if inflation drops, and it has, and prices drop, and they have, why are rates still high? At some point, the Fed's going to have to cave and lower rates. And when rates lower on the short end, all of the possibility opens up for us, but it also opens up for the Treasury Department. Scott Bessent has to figure out how to refinance and or pay for 7 to 9 trillion in debt money this year. Janet Yellen could have the old Treasury Secretary could have refinanced that debt at sub 3% levels, but she didn't. She didn't refinance it at all, which makes no sense. Like, no sense at all. I mean, no sense. So, if the Fed's truly in control, then they're controlling the rates. Well, if the Fed's truly in control, they're tuning the rates to influence the economy, but it's kind of in reverse. It's really the economy that dictates the rates, right? I'm sure you could argue both sides, but if the economy is doing so great, then why are rates so high? Right? So the Fed can say they're independent, but they're really not. By controlling the Treasury Department finances and with Doge's help, President Trump and Bessent are forcing the Fed into action. And they're also forcing them to admit they're being reactionary. The Fed loses power because they're no longer out front controlling the narrative. They give those presentations and they're kind of like, this is the state of things. We're going to keep the rate as is because of inflation. So that by our rate, inflation responds, right? But all of this other stuff has happened to influence inflation. It's not the Fed's doing, right? All of this other stuff has happened and the Fed has responded. They don't like that. You have President Trump and Bessent indirectly stripping power from the Fed, right? Essentially saying you're not in control, right? And they're also going around the Fed by creating that external revenue service. They're also steering the herd and the general impression of the market seen on that CNN Fear and Greed Index, right? Because you realize so much. I don't watch the media, but it is fun. It's fun to see the media react to President Trump. So we have the announcement of tariffs, and that meter went from neutral to 4 on the extreme fear scale. I don't think I've ever seen it that low. I've seen it at 5 maybe during the pandemic, but I don't think I've ever seen it below 5. Uh, so they're intentionally skewing the market. And the herd, they look at the teleprompter, the herd looks at the teleprompter and they don't dig deeper. But that's not you and me. We see more, we want more, we understand more, right? We see a bigger picture. And President Trump is the best of the best as it comes to seeing a bigger picture and playing the market. He can play a crowd like anything, and playing the market's very similar, right? President Trump and Scott Bessent are playing the propaganda teams and allowing them to steer the herd and influence the Fed. Where Trump doesn't have to directly engage Powell in any type of altercation. He's allowing all of this other stuff to do it for him. That's a masterpiece, right? So you have President Trump and Scott Bessent controlling the deeper current. You have them manipulating the herd through the media, shallow water current. You also have them manipulating the deeper current of the economy, all the trade stuff and the tariff stuff. And if you can control the surface and the deep, then you control the system. You can turn everything in your favor. And we are watching a master class of leverage and negotiation for our benefit every single day. It's amazing. And if you pay attention to the game, right, it's one thing to hear the news and respond to the news. It's quite a different thing to think it through and see how it all plays out. Right. But if you pay attention to the game and you play the game as it's dealt, you can ride the gravy train to at least 8%, if not more, monthly dividends and fear and greed and build wealth off the herd's fear and whatever else the teleprompter tells them to fear, right? I get that we cannot escape the herd, right? The herd really does control that fear and greed index. It controls the general momentum of the market. So it's watching the herd and what they're doing, but it's also seeing the bigger picture because the herd, just like the Fed and just like their media handlers, are reactionary. It's this happens and they respond, right? And you're not going to control the bigger events. You can have vision of how you think things are going to go. You can try, it's not like reading tea leaves. I mean, but it's, you're trying to take in all this information and decipher it and filter it and weigh it against possibilities. You're trying to see a bigger picture, but then you have to stay cognizant of the herd because the herd itself, if you let your emotions get the better of you, right, that sways things. That's the herd. The herd is deeply swayed by fear and greed. So when they swing into greed, it's generally a good time to pause or take a breather, really evaluate your strategy. If you're going to buy, then you have to demand a discount and a really good deal. If the herd swings things into fear, when it first tanks, right, and you see that really steep dive, that's the greatest time to buy, but it's also the scariest time to buy because of how much it's tanking, right? But in a bigger picture, you know it's going to respond back up. So you can buy it on the ascension back, right? And still get a better deal than where it started, but you won't get as steep of a deal, as great of a deal as if you buy it at the. It's really hard to time the specific furthest way. Like the top would be the apex, deepest descent. It's really hard to buy the exact trough, right? But if you can catch it on the way down, that's better than catching it on the way up. It's still better than paying full price, right? Or in our case, we're going from discount to deep discount to kind of discount back to discount, right? So if you can see the bigger picture and factor in the herd, you can rake. I mean, you can rake. So all of that backstory sets up the stage for our strategy. We're responding to the current market too, but in a very different way than the herd. While the herd panics, we approach it logically and unemotionally and weigh the data, right? And though the dip overall, it drags on our current progress. Like nobody likes to lose money. No one likes to lose money, but you have to optimize your portfolio. If your buy-in average price is at 8 and suddenly the market tanks and now you can scoop the same share for $5. If you buy at $5, nobody likes to lose money. But if you can buy at $5, it brings your average down, right? Because the goal is still growth of principal, growth of capital. It's also dividends. So we want to optimize our portfolios for the long game. So we have to take advantage of the opportunities that we have. We bought the dip knowing the market will come back. Whether President Trump and Scott Bessent force the Fed to lower rates sooner than later or not, right? Eventually the Fed will cave. They have to because the data says otherwise. You have the Fed holding the line. We don't know how the economy is going to do. Inflation halved. We don't know how the economy will do with tariffs. Inflation dropped again. And now you have them saying the same thing. We don't know how the economy is going to do. If inflation drops further than expected, or if it drops at all, it's going to be really hard for them to keep saying the same thing because you have the news pumping fear and gloom. You have the Fed pumping uncertainty, right? Because tariffs are new, because the whole system's been funded on the taxpayer for years. But the Fed also knows they just don't want to surrender control. So eventually the data will be so overwhelming that they'll have to drop rates. Now, I don't think they'll be like, oh, we're going to cut 1%, right? It's one thing to admit defeat, it's quite another to completely surrender. I don't think we're going to see that. I think we'll see a decrease of rate, right? But we just have to get there, right? So we have that. Then as more negotiating deals get announced, there we go. The market's going to respond too, and the herd's going to start to pump money back into the market because the herd looks at greed and they hate risk. So if the market responds and goes up, the herd will reinvest. So now you have lower costs. People will have more to spend. They can do more with more. They can do more with what they already have, right? And that encourages additional investment by the herd too. It also encourages more people to join the herd, and not that they're going to stay in the herd long term. I was once part of the herd. I am not in it now. Every newbie investor is part of the herd because that's where you start. Nobody really, I teach the market and I teach strategy. I'm a paid member of a service that does similar. Outside of that, I haven't found many people that actually teach the market and explain things. I like to get information from a ton of different sources. I like to compare that information to other things that like I could get all this information if none of it matches, right? But you're looking for trends. You're also looking for truth, and I don't find truth on the news, so I don't watch it. I watch it to laugh at those teleprompter idiots, but because all of those experts are experts in everything and also experts in nothing. So it's fun to watch them freak out. Um, but they don't teach anything, right? I like to assimilate all this information and I like to operate as a hub of information. I like to collect all this data and I like to generate data. That's why I have the spreadsheet. I love data. I like interpreting data. I like strategizing on data. And I like sharing that information with people, which is why I do this. I mean, I can easily justify what we're buying, but I also like to teach people and share information. And so I'm sharing information about stock markets and how we're investing in the stock market. And quite honestly, how you can beat the herd out inside the stock market. And I looked at this data again today. Uh, our former financial advisor was investing our portfolio and not in a way that was in any type of benefit to us with more than $120,000 invested. He was generating less than 2% growth in dividends a year, while the equity stocks weren't exactly growing either. And very much to Kiyosaki's advice, most financial brokers leave you broker than them. Equity stocks work on paper. And if you time it right and you play, like you can do a lot of stuff to manipulate it in your favor, but if the example I use is the same one that was given to me. If you buy Apple now and it grows 10% in 5 years, you're 10% ahead. But that's not actually true. 2% growth a year sucks. 4% inflation a year, and you have no growth. You've lost money the first year. You've lost money in 10 years. When Apple pays you a shitty dividend, you still lost money. So that's not a great investment model. But that's what most investment brokers do. They buy growth stocks so that in 10 years you have more money, but it's been devalued by inflation and they don't pay dividends. That's not a great growth model. Most brokers leave you broker than them. So yeah, we didn't generate a ton of money, but our broker got paid. So yeah, our current portfolio, I'll show you, it's quite different with what we have invested now. So what everybody wants to know is this a prolonged dip? And I don't think it is. I think it's transitory. I think it's a transition into more America first economy, right? And that overall should shape our investment strategy. So should you invest in China and all these other countries that are essentially recognizing the US as first, right? And China's currently going through that battle. Trump says they want to make a deal, and I think they do because they want access to our economy. But they also don't want to admit defeat. So they're going to go back and forth on tariffs until Trump hits back harder, right? And eventually we're going to find a KO. It's Trump hits, and yes, he's going to let you hit back, but at the same time, he's going to hit harder back, and he doesn't surrender. He does not surrender U.S. interest in a fight. Like he will fight for the U.S. no matter what. So he started a fight for the U.S. He's not going to back out of that, right? And the first person to cave loses. Now you can cave and do a great thing for your country. Like China, at some point, will come to the table and say, "Yes, we'll agree to this," and it'll be a good deal for them. But having to cave to the U.S. puts the U.S. first, right? And we haven't had a prize fight on world scale I'll say economic prize fight like this in a while. So we'll see how it plays out. I think the U.S. wins. Okay, and based on that, me personally, uh, we're investing more in the U.S. than we are. Like we have global funds that do business everywhere. But if we have the choice between a mostly U.S. company and an all U.S. company, we'll go all U.S. Um, so I think I've talked long enough. So, or at least about strategy. So if you've been following along with what I'm doing, your portfolio really ought to be ideally placed, right? Whether it's a slowdown, a brief recession, maybe it's a pause, right? All of that's why recession. I don't think we slow down that much. Um, I really don't. I'm more on President Trump's side of things. I mean, he said it's a great time to buy, right? It's a great time to get rich, and that doesn't sound like doom and gloom. That sounds like a guy who's not worried and who's telling us not to worry. And if you watch his schedule, he's doing more and answering more questions, and he's being more active than anybody else we've seen in that position in a while, right? And it is a great time to buy. Although I still think we need some awareness. Like I wouldn't go all in, right? You want to focus on strategy and data and not your emotions. And whatever your strategy is, it's still just as important now as it has been, right? So if you're buying, we already bought. We're not going to buy this week. If you're buying, what would you buy? Consumer stocks? No way. Too volatile, right? On the flip side of that, if you time the market right, which there's no really timing the market. If you bought it on the descent or near the bottom, you got a great deal on blue chip American stocks. But at the same time, it's still a very volatile market space. It's going to go up and down, right? And however the media spends it, the herd's going to respond, to be honest. So if the market has another sell off, we drop lower, maybe that's another time to buy. But I still wouldn't buy America. I still wouldn't buy consumer, whether American or global, blue chip stocks. But at the same time, you can make the argument that it's a great time to scoop a deal. Like when everybody's running tail between the legs, maybe that's a good time to buy for you. I don't. Pending the scenario, maybe that would be us too. It would have to happen again for me to find out. Tech, no, not unless you can scoop a deal. Bonds, BDC, business development company, loans, CLOs, collateralized loan obligations. Yes, with Bessent and President Trump focused on bringing the 10-year Treasury note down, Treasury rate down, right, which has already dropped, it's a great time to buy bonds. And with the Fed hopefully lowering rates, it's better to be in bonds sooner than later. It's also better to be there before the herd gets there. And with the economy volatile, with the giant sell-off, the herd is looking for assured money. Right? You have a part of the herd, a large part of the herd that's sold and backed out. You have other parts of the herd still in the market, and they're looking for the next best investment. And it's definitely not in equity or growth stocks. And they're going to realize that bonds pay well. And they're also hopefully going to realize that closed-end funds are a much better pair than the S&P 500. Uh, let's see, what else? Oil. Oil is a bond proxy, and it factors into everything. Control the oil, control your own oil supply, and the market roars. But with the dip, even though the dip puts oil to a degree back in the options list, but it doesn't really make the cut because it's still more expensive now than when we bought it. Natural gas outright as a solo, not right now. It's still well above bargain basement prices at $2. If it's part of a package like in a closed-end fund, natural gas is a cheaper way to cool your electronics than using the water supply, and utilities are a thing. So you have, whether energy transfer, utilities, those are all bond proxies. So as do bonds, so do bond proxies. So if rates drop, bond value should go up. And with the herd looking for definitive income and safe income, they should push into bonds and utilities. Uh, Real estate is another bond proxy. And same thing. So with rates finally poised to drop, real estate looks better and better. And if you can find a company like a well-established company at discount, that's a good deal. If you can also find a relatively new assortment of funds at discount with more coming online, that's a good deal too. So if you throw in cheaper costs because oil is cheaper, and then you add a slightly lower demand because ICE is deporting millions of people, and then you add a slight increase in supply, partly from deportation, partly because more stuff's coming online. We're set up for a real estate boom. Cheaper supply, cheaper manufacturing, right? The process is easier, lower rates, more availability. Sounds like a really good situation. I just don't want my property taxes to go back up because the value went up again. So I say all of that before we sort the list. And I get it's a ton of info. It feels like a ton of info. Like I tried to streamline it and it still just feels like a shit ton of information, to be honest. Um, so let me share my screen. All right. So I went through the closed-end fund. You can see my teaching tab there. Um, I went through the list and I updated all the color-coded funds. The dark blue is the Roth, light blue is what we own in a cash account. Green I track, purple is recommended by somebody that I read and trust. Um, some of these funds we own in both accounts. I just haven't found a better color coding system, but I'm working on that. Um, so what did we end up? So this was the list before we bought, and that was my budgeted amount. Like I look back at what we spent the last couple of times. I'm trying to um, control the rate of our investment, kind of dollar cost averaging myself, and then tracking total investment and then the remainder. And I realized that, I mean, it's the diversification side of things. You can invest in everything, but it's hard to invest in everything without spending everything. Um, so I ended up with this list, which really I just cut out the MLP. I cut out NML and KYN, mostly because despite being in discount territory, they're still higher than where we bought them. So I wanted to try to focus on stuff that was lower than we bought it, so it would bring down our average. Now it might only bring down our average 3 cents, but that's better than increasing our average. Or and I'm talking about cost of share. Like if I can lower our cost of share, whenever we sell for a better price. Sometimes you have to buy at a higher rate. That's great. That wasn't my goal. So this is what we ended up buying. Um, as I scroll over, so I didn't spend all the money. We increased our monthly dividends to that, our yearly dividend, our overall yield, and how it plays off on the list. And quite honestly, yes, this is our portfolio. I mean, this is everything but our account information. Let's see, yellow boxes because when I bought, the ex-dividend date was not updated. This is because I'm retrying to transfer everything from Webull into our Fidelity account. Fidelity because of ease of access, and I think I can get it all under one umbrella. Webull, I like. I mean, I like their format. I like their dividend display, but I'm trying to streamline into one company that can do it all. Um, and I was reminded that Webull is the online presence. They have a different. They're managed by Apex Clearinghouse. So if I really wanted to do a transfer of assets, I have to do a transfer between Apex and Fidelity because Webull doesn't actually hold any of the holdings. So they have nothing to transfer. It's just the online system, which is kind of weird, but such is life. So if I can transfer our Webull individual cash account into Fidelity, then I will lose these three tabs and combine them into the Fidelity tabs, which will save on my tabs. Why I haven't transferred the Roth yet is because there's a $25 transfer fee between Webull to any external account. And I have to ask my tax guy how that's going to impact my Roth and taxes because I don't want to take money out in advance. Um, so we have the ex-dividend dates I got to go back in and fix. We'll see if I get to import data and combine accounts. But otherwise, the yellow blocks are when we bought. And this is our actual portfolio, which I'm not hiding the yellow blocks, but I'm just trying to show you our overall portfolio. Trying to be as transparent as I can be. I track total shares. This is our total investment. So with you think back, with over 120 grand invested through our former guy, generating sub 2% dividends, we were generating maybe 2,100 a month, or it's not a month. We were generating maybe 2,100 a year with over 120 invested. Currently, we've got about 50 invested, and we're generating about this much a year. And I say about, but it's really those are the numbers. This is here because that's the dividend value off of our individual cash account at Webull. So together, and I mean, total money would increase, but we would increase our overall dividends considerably higher than what we ever met, like our wildest dreams with our previous guy. What we've been paid so far, our overall dividend ROI so far, current value, still with the dip. We bought the dip and resulting factor, yes, everything dropped. Like, so we have our existing price that dropped because we're still in dip volatile areas. So we have that overall value decrease. Total ROI is still negative because of where we are in that cycle. As it goes back up, that'll improve. And honestly, it's going to go up and down. It's always scary to watch your portfolio drop, right? And I can track stuff every day. I could, but that honestly breeds anxiety. I track it weekly or try to. Sometimes stuff comes in the way and I can't track it weekly. And I'm honest when that happens. But I track it weekly. That's enough. If we buy stuff, I'll track it when I buy stuff just to make sure I get the most accurate deal. But the goal, I mean, the overall goal is return of capital. The overall goal is to increase our value, but we also want consistent dividends because I know it's gonna rise and fall. I want consistent or increasing dividends. So regardless of the dip, this happens, right? And if this takes off and it goes crazy positive, then I have the hope that the dividends will increase, right? So we want to focus on overall return of value, maintaining. We don't want to lose, but we also want to ensure that we get great dividends. So once, hopefully it's this week. and I'll further update things and have a much prettier list for you. Uh, this week, we get to sort this list. So everything's a target based on discount. Every discount is significant based on the historical discount for the individual funds. We want to sort first based on, is it a monthly payer? I love the idea of ADX. It's a US blue chip company. It's great. Track record is great. The company is great. It's a quarterly thing, kind of. It's an off quarterly fund. Um, 25, it should be 25811, but it's 25812. To be a true category two, but it's that slightly alternate schedule. Um, I mean, historically, it's a great fund, but currently, I have a hard time buying stuff 3 months, 2 months, 1 month in advance and not collecting a dividend. I could buy it a month from now and then get the dividend for May, but then I have to wait a couple more months for the next dividend. And I like the idea of consistent payers unless I can truly justify that quarterly payer. So now that everything's monthly, now we can really break it down by yield. If cost is your burden, then break it down by cost. I would, well, you can do what you want. My general metric is 9% or better unless I can justify a cheaper company. I've been able to justify this one, right? And I've explained it before. There's three exceptions to my asterisk rule. This is one of them. So if this average drops below the 52-week average, then it's actually in discount territory because it rarely goes in discount territory. Rarely goes in discount territory. So by its own performance, it's a discount now. But when we bought it last week, it was an actual discount. We bought it at 3% discount. Uh, so it's hard to justify it this week. There we go. This is, I mean, based upon the metric, it qualifies for the triple asterisk. It doesn't make the cut for the week for two reasons. One, buying this would increase our average. Our average at 400 shares is almost $9 a share. And I only know that because I've seen it so much, right? So buying it at $11 would increase our overall share cost. I don't want to do that. I would maybe at some point, but I don't want to do it right now. The other factor is the yield. I want to, if I'm going to stick to the 9% rule, I cannot justify buying this at less than 9% when I'm going to increase our yield or when I'm going to increase our share cost. So we're going to cut out these. Now we have a shorter list. So our targets are still the same: bonds, loans, BDC, energy, utilities, energy transfer, real estate, and oil if we can really truly get it cheaper. But I don't think we're going to find oil that cheap. It stays on the list because of positioning and all of that, but it's really not going to make the cut. We're already heavily invested into bonds and different bond companies. We've got a CLO. We've got one stock fund that we kept and didn't sell. You could argue that we should sell it and come back to it really when it's in a worse condition with the volatility, but we're going to keep it for now. Um, I really can't justify adding any more bond funds, but that's me. Um, so, like, if I'm going to add a bond fund, it's got to be better than what we already have and give us an advantage that we don't already have. And as much as I like PDO, I mean, by name recognition, all I'm doing buying PDO right now, which PDO would be one of the other triple asterisks, ADX would be the third, that quarterly company we eliminated. Okay, I could argue for PDO because it's pretty much break even on pricing, and it's generally not, right? As you can see, but it doesn't really give us anything different than what we already have, except for the intrinsic brand name of the company. DLY, we own a sister fund, and DSL. This adding this one doesn't add to what we're missing. So PHT is bonds. Let's see, VDI. Yes, but not different than what we already have. Mostly bonds. That's mixed. bonds and mix, same thing as what we already have. Hicks doesn't outperform the market. Um, so we can get rid of, and this is not me sorting the list based on like I want to focus on what we already own, but your portfolio is going to steer you where you need to go. Uh, like if all you have is growth, like if all you have is single stocks, if it's me investing, I would invest in bonds. But at the same time, it's your portfolio and your money, and I don't want to invest your money for you. So uh, last week's decision, OXLC rarely goes into discount. ECC does things very similarly. It's a very similarly structured company. We bought OXLC because it's cheaper. Um, you could argue they pay a higher yield, but not by much. Let's see, Hicks doesn't beat the market. ECC doesn't add anything. Like it would give us variety, but that's diversification for diversification's sake. It's not really needed. TEEP is everything not oil that depends on oil. It's a poor, it might make sense to you. It doesn't make sense to me. They are interested in everything renewable, which is not really renewable. It's all dependent upon oil, and it's all dependent upon oil to be made and constructed and maintained. And yet they hate oil and want nothing to do with it. It just doesn't work for me. Uh, let's see, ETB is stocks, NBXG is all stocks, ETB is stocks. So we have CLOs, taxable senior loans. We have a mix of things that I've advocated against recently, although we picked up 100 shares of it simply because of price value. Um, 200 shares. We picked up 200 shares, but simply because of price. No, 100 shares. I was right because of price. Uh, let's see. This one. That is not what I wanted at all. This. There we go. We picked it up because of price, and quite honestly, I like rounded numbers, so 500 looked much better than 400. But my real justification was the price. We lowered our buy-in price, and for as much as I dislike their desire for diversification for diversification's sake, they're doing quite well with their existing strategy of the not portfolio when it can strategy and going with real estate, utilities, and energy. They're doing quite well with that and the bonds part and the bonds part. They didn't need the other stuff, but it's the diversity for diversity's sake. And I don't like that strategy. So now we have real estate, but we already own a Cohen and Steers fund. Um, we own a sister fund. So adding a fund that does something similar, we own RFI. Yeah, we own a similar fund. So adding a sister fund that also does something similar for more doesn't make sense. So I'm still left with stuff we already own. Um, but of the list, could I trim it down further? And yes. Um, CIF, and I've said this week after week, I like the CIF portfolio. It's the one thing that I could truly buy in the Roth account based on current funding. Like if we have $188 just sitting there at $1.59, I can pick up 100 shares and buy something. But with me trying to figure out how to transfer how to transfer the account around, I really don't want to buy right now. But if I had to pick between these two, I would pick CIF based on money and availability. But if you're going to give me the option of just picking one and buying, I would buy this one because it's an all American company instead of a most of America company. It's an all American company. They're, I mean, both funds have super high fixed income, but FCO is the private lender. It's the BDC inside of a loan or inside of a bond company, and that gives them greater access and ability. BRW, they should be well placed in the existing and coming market, and then you still have real estate, and it's to some people it might be the riskiest one on the list because the discount's so high. I still think the light at the end of their tunnel is actual light and not a train. Um, just waiting for them to get more square footage online. Um, but if you really wanted me to narrow it down, if you really wanted me to nail it down and not be wishy-washy, what would I invest in? Um, I would go bonds and honestly not bond proxy. I would go, well, I would buy OXLC because it rarely goes on discount. These two companies are extremely similar outside of their asset value. Um, but we bought CIF knowing the roller coaster. I mean, its track record really is like this versus FCO, their value is increased, like their discount has shrunk while their overall value has gone up. And then you add the tariff scare and the market dip, and I would buy that one. And of the other three, I mean, yeah, I realize we just picked up 100 shares based on price, and it is. I mean, everything's low at the moment. Um, it still wouldn't make my list. If you're really gonna nail me to the floor on picking stuff, uh, despite us previously buying, like if you were gonna force me to buy tomorrow, I would buy these three things. This one rarely goes on sale. That's gosh, Boaz Weinstein heading this up is extremely well placed, and this just has a ton of problems between their general management. I mean, they're a private company, now they're public, and within the year, their discount has just shrunk. And then you add in the tariff scare, and everybody's discount came back. It's just a great time to buy. And we can play the what if game. I know. I mean, that's the market, right? Like, have your strategy and roll the dice, but we're doing something that's a little more well, we're doing something that's very much less helter skelter and crazy than what the media is doing. It's here's the strategy, here's what we think is going to happen, here's where we believe we're trending. This is the bigger game, this is the bigger vision. It and even without all that, with inflation lowering and the Fed's purpose is to control inflation, whether that's working for you or against you, right? But with inflation lowering, it's really hard to justify, or so with inflation decreasing, it's really hard to justify keeping rates high. So the age-old game, when rates drop, bonds go up. And that plays well for those three, just on that advice alone, not for everything else I've said tonight. If rates drop, then bond value will go up. And that plays for those three things. It plays for CIF too, but they lack the BDC part. And the BDC with Scott Bessent, who's a business guy, small business guy who wants to invest into America and help Americans and businesses. The BDC component is a significant thing. So we bought CIF on the roller coaster, hoping at some point it would scale back up and make it to the top, and we would sell it. FCO, we bought to hold. So if you're going to force me to buy anything, I would buy those three things. And outside of that, that's what I've got. So if you like my content, consider subscribing to the channel and then help me hack YouTube by leaving a comment, share the video, and click that like button. And if you want to find me day to day, you can find me on the video. Like you can leave a comment or you can head over to Facebook and find me on Navigate Your Finances like somebody recently did. So I hope you have a great week. I know I've been talking for a while. I really hope this downloads and records because my computer's finicky. I really hope I don't have to do this again. Not that I don't like talking and going through this, but it would be the second time. So I really hope this one works. But whatever you have for the week, it's a short week for most with Easter coming up. So whatever you have for the week, focus in, lock in, get your stuff done, and have a successful week. And then enjoy Easter and what it means and enjoy the weekend. So I wish you well. I wish you a successful week. If you have no market strategy, it's a good time for market strategy. And if you want advice on that, leave me a comment. So otherwise, I will see y'all on another video. Have a great week, everybody. Bye bye.